Hi friends, when markets are crashing or falling, you need to have smile on your face. Rahul, what are you saying? Have you totally lost your mind? Are you ready to go to Madhouse in Agra? Point is, who wants to see their portfolio in red and who wants to smile when their portfolio is down in red? See, it's not me who is saying that. It is the data that is telling us to smile when markets fall. Allow me 3 to 4 minutes of time and I will show you data-backed analysis, and that will drive home 3 hypercritical points when it comes to market correction. Also in the video, I will speak about 2 investment strategies during the market falls. Important video, please watch it without skipping. You will learn a lot. So if I take last 4 years of data, first chart that you see here is that between December 2022 to March 2023, Nifty fell by almost 10%. Second fall, if you look at the second fall here, which was between October 2021 to June 2022, market from all-time high went down, and the correction I can see here is almost 20% correction. And the third scenario that I want to speak about is the COVID scenario, where between February 20 and May 20, if you see, the market fell by close to 40%. So these 3 corrections of 10%, 20% and 40% have something very common that I want to discuss with you. The first hypercritical point that we can derive from these 3 falls is that every time market has fallen, within the next 12 to 14 months, market have fully recovered. Let me show you with the data here. So let's consider the first fall here. And if I go back and talk about this fall here, you see that somewhere here by the month of June, so the market started to fall in December 2022, and by the time June hits, within the next 6 months, market were fully recovered and the Nifty was back to its original level of 6 months. If I consider this one here, you will see markets were started to falling in almost October time frame. So let me just show it to you, October time frame. And by the time almost November came, it took market almost 13 months of time to fully recover. If I talk about the COVID period here, and if I just select this period here, you will see market started to fall somewhere here. And if I just draw the line somewhere here, by November 20, almost 9 to 10 months of time, markets were fully recovering from 40% fall. So no matter how big or small the fall is, we saw 10% crash, it recovered in 6 months time. We saw in 20% market crash, it recovered in 13 months of time. And 40% of market crash, it recovered in 9 months of time. The point is very simple. These last 3 crashes of various sizes, what they have shown us is that market have managed to recover fully within the 12 to 14 months of time. The biggest conclusion we can draw from this analysis is that if you happen to invest when the markets were all-time high, so for example here, somewhere, or so for example here, do not worry, do not panic, do not worry, do not lose your sleep, because if you are an equity investor for long term, minimum 3 years of time horizon, then within the next 12 to 14 months, market will recover, fully recover. However, if you are investing in equity market for few weeks, few days or few months, then yes, you have all the reasons to be worried about market crash. The viewers of this channel, I would humbly request you to only invest in equity market if you have at least 3 years of time horizon. So hope this hypercritical point number 1 is very clear, that if markets are crashing and if your portfolio is in red and if you are a long-term investor, do not worry, sit tight, don't panic, don't lose your sleep. You'll be all right within the next 12 to 14 months. Market are likely to recover. If you like this analysis, request you to hit the like button. Let me know in the comments a simple thank you. It will motivate me to continue to do a lot of good work for you at zero cost. Also, you can consider subscribing to my YouTube member community, where I post in-depth analysis of stocks, market, macroeconomics factors, mutual funds, ETFs, and so many other assets that might be very valuable for you from a learning perspective. Coming back to the second hypercritical point that we will note is that every time markets have crashed for a shorter duration of time period, in a longer run, they have come back very strong. Have a look at the COVID example. When the markets crashed somewhere here, after the recovery, you see where the markets are right now. So the markets recovered at 12,000 level of Nifty. Right now, where the markets are, within the 4 years of time frame, the markets have gone to 22,000 level. So if you allow the markets some time, 4 years, 3 years, 5 years of time period, markets will not only recover, they will strongly rally. There is a chance that they might rally further because of the long-term earning potentials in the Indian market. Look at the second example, where the markets were all-time high at 18,500 level, went down to almost 15,000 level, and now where the markets are, again 22,000 level within 2 years of time. Have a look at the third crash again. Markets went down from almost 18,000 level to almost 17,000 level, and now they are back up to 22,000 level. So the point is very, very simple. Over a longer period of time, markets are likely to continue to move upwards because of the earning potential that the Indian industry have right now. That brings me to critical point number 3, that people who have invested during the market crash, they are the ones who are smiling the most. For example, look at this first crash here, and people who invested when the Nifty was at around 8,500 level during the COVID crash, their money has almost tripled, right? 8 into 3 is 24, around 22,000 level, almost just shy away from tripling the money within like what, 4 years of time frame. That is a phenomenal money profitability that people would have got. Have a look at this crash here. People who invested somewhere here, or for that matter here at 15,000 level, Nifty has gone to 22,000 level within 2 years of time frame, which is almost, I would say, 50% gain within 2 years of time frame. That is huge. Also have a look at the last crash, and you will notice that if somebody put a money here at 17,000 level, it would have gone to 22,000 level within like a year's time frame, and that to me is almost like 30% gain. So point is very, very simple. People who put money during the market crashes, they are likely to make a lot of money if they continue to hold this for longer period of time. Let the markets recover first and then wait for the markets to rally further, and this makes a lot of money. Hopefully this third critical point would have given you this insight that when markets are falling, it's not just that you need to go away from the stock market. In fact, you need to consider opportunities to invest in the market so that over a longer period of time, when markets recover, you are more profitable. With this spirit, I want to now move into the investing strategies during the market crash. So let me talk about that now. So what should be our investment thinking when markets start to fall? For that, we need to consider 2 points here from these charts here. Point number 1 is that you will see that when markets started to fall, so during the COVID here, nobody could have predicted that the market will bottom out at around 8,000 level. Again, in this fall, nobody can predict with 100% confidence that the market will bottom out at 17,000 level. So the point is simple. We do not know how far down the market is going to fall. So that is point number 1. Therefore, it is extremely hard and complex to time it perfectly to put your money when the markets are bottoming out. This is the harsh reality that we need to admit. The point number 2 you will note here is that markets have not fallen in one single day. They have taken few days to weeks to get to the bottom of the market. So for example, here it is taken what, almost a month's time to crash by 40%. Here as well, you see the markets were down here, then went back up, then came down and made further low here, went back up again, came down. So the point is that the market is not moving in the linear fall. It is actually going zigzag, and you don't know how much by when the market is going to fall. Therefore, when markets fall, our investment thinking should be that we don't need to put our money in one single go. So let's say I want to put 10 lakh rupees when the markets are falling. I am not going to put that 10 lakh rupees in one go. In my view, what I need to do is break this 10 lakh rupees down into 3 or 4 buckets. Now, there is no magic formula here. Find out what works for you. For me, 3 to 4 batches is a very, very sensible way. And every time market falls by 5%, I put almost 1/3 or 1/4 of the money. So in this example, if I want to put 10 lakh rupees, when market falls by 5%, I put, let's say, 3,50,000 rupees roughly. Another 5% fall, I put another 3,50,000 rupees, and so on. Now you might say that, Rahul, what happens if the market fell by 5% and it never went to another 5% fall? Absolutely fine. I put in some money in there already. Second scenario, you might be thinking, Rahul, at 5% fall, if I put some money and by the time I go to 15% fall, my money is exhausted. What happens if the market falls further, 20%, 25%? Absolutely fine. It is not possible for you to predict the bottom, as I said in point number 1. Therefore, what you have done is at least you put some money at 5% fall. You put some money at 10% fall, you put some money at 15% fall. And over a long period of time, as we understood in the beginning of the video, all these little falls will help you to accumulate the wealth. This, in my view, is a very, very sensible way of putting money during the market crash, because let's face it, when markets crash, there is so much of hoo-ha in the market. Experts will start to tell you that market is not going to recover. Experts will tell you all sorts of problems. There will be news all over in the media. It's very, very hard to put your money during the market crash practically. Therefore, this batch approach of putting your money during the market crash, in my view, makes lot of sense to me. Okay, so far if you're with me, now let's move to where to invest our money when the markets fall. In my view, one of the very good option is broad index investing. So there are various indexes such as Nifty 50, Nifty small cap, mid cap, etc. Typically, what happens is when market falls, when Nifty 50 falls, all other indexes are likely to see the same pressure, albeit in a different scale. So for example, if I show you, Nifty during the COVID fell by close to what, 40%, 39% here, depending on where you're looking at the dates. If I show you the mid cap 150 index, Nifty mid cap 150 index, that fell by close to same amount, 40%. And if I show you Nifty small cap 250 index, this index fell by close to 46%, slightly more than the mid cap and the Nifty. The point is very, very simple, that when the markets are falling, it is likely that all indexes are likely to be falling, albeit with a different levels. So investing in broader indexes make a lot of sense. And in my view, 3 indexes that I look to invest is Nifty 50, which is top 50 stocks covered by Nifty 50. Second is Nifty mid cap 150 index that covers stock number 101 to 250, all the mid cap stocks. And number 3 is Nifty small cap 250 index, which covers 251 to 500 number of stocks. You may have a natural question here that, Rahul, why not Nifty 500 in that case? Look, my view is that if you put all your money in Nifty 500 index, you can't really allocate your money. So for example, if I want to put 10 lakh rupees and if my portfolio tells me that I'm already heavy on small cap stocks, I want to put more money in mid cap and large cap, then these 3 indexes allow me that flexibility that I can choose 50% money in large cap, remaining 40% in mid cap and only 10% in small cap, because I know my portfolio is already heavy for small cap indexes. So the flexibility these 3 indexes provide you to allocate your capital makes a lot of sense. That's why I personally like these 3 broad indexes. Second key point is how to put money in the indexes. There are 2 good options. One is the index mutual funds. I have created few basic videos on my channel. You will find them and you will learn about index investing. Please go and watch them. And the second option is the ETF route. Now, if I talk about what is the difference and pros and cons of indexes versus ETFs, it is going to take me a full dedicated video to talk about it. But in the context of market crash, in my view, ETFs are more preferable. I prefer ETFs, and the reason is that ETF allows you to lock the index fall immediately. For example, when you put your money using the index mutual fund, it might take you at least 24 hours to 72 hours to get your units allocated to you, because you will go to your broker, you make a payment, the broker will then pass this money on to the mutual fund house. That will take some time. Then mutual fund house will receive the money and will allocate you units. Typically, it might take anywhere between 1 to 3 working days. And what happens if the Nifty by the time recovers back? And this is why there may be a loss opportunity if we take the index route when it comes to market crash situations. While in case of ETFs, let's say Nifty at 1 p.m. for example is down by, let's say, 8%. Now you want to grab this opportunity, then ETFs are going to give you almost similar level of fall. It might not give you exactly 8% fall because of the tracking error that every ETF carries, but it might give you, for example, 7.5% or it might give you 8.5%. It is going to be thereabouts, and ETF that way is a great way to lock your money during the market crashes. Now comes the second investment approach or investment thinking when markets crash. In my view, that is your individual stocks that you have curated and they are long-term stocks. So look to invest your money into the long-term stocks that you have created in your portfolio, because what is likely to happen when market crashes is that majority of the stocks are going to be under huge pressure, no matter how good the valuation is, no matter how good the fundamentals are, because the sentimentals overall, if they are negative in the market, every stock will get beaten down. And if you think that the stocks that you have in your portfolio, which are long-term stocks, you are ready, they are good stocks, they have the sectoral tailwinds, for example, the company is growing profits and revenues year on year, and you really want to hold those stocks for long term, then market crash give you that opportunity to put some money into those long-term stocks. But one thing most of us miss out is on preparing for a market fall. We are not really prepared and we get caught when the market all of a sudden crashes. Market is not going to give us a warning. I mean, there are some signals that you can take, but it's not going to give you warning. Like in COVID, market just fell by almost 40% within few days. So nobody is going to give you that clear warning or signal that it is going to go down by 40%. Therefore, keeping us prepared during the market fall is very, very important. And for this, what you need to do is keep the buying levels ready with you for your long-term stocks almost all the times. Right now, do you have your list of long-term stocks in your portfolio, and do you know what are the buying levels that you are going to buy the stock if the market crashes? The answer is no. Therefore, what you need to do is go back and prepare a list of your long-term stocks and also have some buying levels written next to them in case market falls. And more importantly, continue to revise these buying levels quarter on quarter basis, because every quarter the company will publish their earnings, their valuation might differ, there may be some structural changes. Giving you an example, let's say Jio Finance is, let's say 350 level rupees right now, and you think that Jio Finance is your long-term bet. Not a stock recommendation, I'm taking that as just an example. And now you need to be ready that I am going to buy or accumulate Jio Finance in a big way. I'll put a lot of money in Jio Finance. If the Jio Finance comes down to, let's say 260 level, 270 levels, this is the homework that you need to be ready with. Again, these numbers that I've given you, these are no recommendations. I have just randomly thrown some numbers here for us to just understand the concept of keeping our list price ready in case markets fall for our long-term stocks. Because if there is nothing wrong fundamentally or from a valuation perspective in a stock, then there are chances of getting good money out of these long-term bets. When the markets recover, the stocks are going to go very high in prices. So I hope this long-term stock investing approach also is very, very clear to you. Please make sure you're all the time prepared for market crashes. It can happen anytime. So in this video, we have learned a lot about market crashes. Let me know any points that I could not cover in this video that you want to add in the comments. I'll be more than happy to read your comments. I hope you enjoyed this video. I'll see you in my next video. Until then, keep rocking.